Welcome back to 18 Now's Market Cafe. Now we've reached that part of the segment where I get my colleague Ashesha to gives us a perspective on the stocks to watch out for before we go into trade this Friday morning. Good morning, Ashesha.
Hi, good morning. So Tata Elxsi, the first one, it reported its numbers yesterday post-market hours, and a good set of numbers coming in from Tata Elxsi this time around. Top line is above street expectations. Commentary is optimistic. Attrition has slowed on a quarter-on-quarter basis. Talking about numbers in specific, revenue has come in at 726 crore rupees, a jump of 6.5% on a sequential basis. Profit after tax has seen a rise of around 15.5% on a quarter-on-quarter basis. EBITDA is also up 7.6% on a sequential basis. Company's commentary is quite optimistic. They are saying that they are entering Q2 with strong order book and healthy pipeline. Growth was primarily volume-led and it was across verticals. Attrition has slowed down. It has come in at 19% versus 20.8% on a quarter-on-quarter basis. Tata Steel Long Products also reported its numbers yesterday post-market hours, and a weak set of numbers coming in. Revenue from operations is up 18% on a YOY basis, but the company has reported a loss of 331 crores this quarter versus a profit of 331 crores same time last year. Higher raw material costs and inventory write-down is the primary reason why the company has reported a big loss this quarter. Additionally, higher interest cost due to Neelachal Ispat acquisition that they did this quarter is also one of the reasons why the company has reported loss this quarter. As far as other internals are concerned, sales volumes are up 10% on a quarter-on-quarter basis. Realizations are also strong. However, raw material cost is up sequentially. Reliance Industries, ONGC and Oil India will be the next set of stocks that will be in focus today. Government of India might consider lowering windfall tax on crude oil production and exports of petrol, diesel and ATF, and hence keep an eye out on these stocks as well. Engine One also reported its numbers. Consolidated revenue from operations is up 45% on a YOY basis. Overall equity market share for this quarter stands at around 20.8% versus 21% on a sequential basis. Gross client additions, however, are down 14.4%. However, client base has come in at 10.4 million, up 13% year-on-year basis. BEML will also be in focus. It has received an variation order worth 262 crore rupees from 88 MEMU cars. And lastly, Borosil Renewables will be in focus. It has approved preferential issue of 26.62 lakh shares at the price of 674 rupees per share, aggregating to 179 crores to SHTG Glassberg GmbH. Remember, board has additionally also approved fundraising to the tune of 1100 crores, so keep an eye out on Borosil Renewables as well.
Okay, Ashesha, thank you so much for the whole host of list of stocks that will be in focus today at 9:15 a.m. But let's move on and bring you what the brokerages are saying this morning. And Vamakshi is here, as always, to tell us more about the brokerage notes. Good morning, Vamakshi.
Well, good morning, Vinny. Let's start off with the IT sector. Now, Morgan Stanley has come out with a report. Now, they've upgraded the rating on L&T Infotech. It has been upgraded from underweight to equal weight. However, the target price has been cut from 5,500 to 3,900 per share. Now, we have downgrades coming in for HCL Tech as well as Wipro. They have been downgraded to underweight. Their target price also has been cut. So, HCL's target price has been cut to 810, whereas Wipro's target price has been cut to 355. They've maintained an overweight on Infosys, Mphasis as well as Tech Mahindra. They've maintained an equal weight on Mindtree as well as TCS. Now, according to Morgan Stanley, near-term headwinds and a lack of catalyst could keep the sector performance under pressure. Valuation multiples have definitely come off, but stocks still trade at a premium to their historical averages. They also believe that the sector will continue to see headwinds in the near term and the earnings downgrade cycle is expected to continue. Apart from that, we'll focus on CG Consumer. Now, two reports coming in. The first one being from CLSA. They've maintained a buy on the stock with a target price of 465 per share. Now, Butterfly Gandhimathi Appliances reported its Q1 numbers. They say that it is a good start, but a long way ahead. Results are encouraging, but the run rate is not enough for EPS neutrality. The path to EPS neutrality, in fact, according to them, in FY23 looks quite steep, and demand will be a key monitorable going ahead. Credit Suisse also has come out with a report on CG Consumer. Now, even according to them, Butterfly reported a strong set of numbers. But unlike CLSA, they believe that EPS break-even is within reach. A significant margin expansion can be structural, and commodities can aid the margin going ahead. So that is CG Consumer for you. Moving on, the next stock in focus is ACC. Now, Goldman Sachs has maintained its neutral rating with a target price of 2,100 per share. The company disclosed its Q2 calendar year 22 results, and they were largely a miss, driven by higher fuel costs. Steep rise in pet coke, imported coal prices hit the profit and loss this quarter. Goldman Sachs also does not expect Ultratech, Shree Cement as well as Dalmia to see a similar EBITDA per ton sequential decline. Morgan Stanley has also maintained an underweight rating on ACC with a target price of 2,050 per share. Now, EBITDA was below estimates, driven by weaker than expected performance on cost. They believe ACC numbers cannot be extrapolated directly to the industry, and they see potential for negative surprises on the OPEX by the companies.
Okay, Vamakshi, thank you so much for that update coming in. But let's move on. We do have L&D Tech Services, which will be reporting its Q1 numbers. We'll be comparing on a quarter-on-quarter basis. Being a tech company, revenue growth of around 4% is what we are expecting. This is a rupee revenue growth, dollar revenue growth of around 3%. While in terms of the EBIT margins, we're expecting a slight bit of a contraction of 20 basis points, 18.4% versus 18.6%. Profits, a growth of 6% is what we're expecting. Profits expected at 277 crores. Now, obviously, what we'll be watching out for in terms of commentary of the ER&D spending for the current year 22, verticals commentary coming in from the management, deal pipelines, conversations on that, and any guidance update coming in. We expect the CC revenue growth to be at 3 to 3.5% on a quarter-on-quarter basis. So keeping an eye out on that, because margins are expected to see that decline due to the supply side pressures coming in.